and things like that. I'll try to make it short and quick, maybe about 20 or so minutes. Number one, central bank is a financial institution responsible for monetary policy and regulation of the financial system, or shorter, financial regulation. That's the central bank. Next piece is monetary policy. Monetary policy is the economic policy of controlling money supply. In other words, the central bank is responsible for the control of money supply. Money supply has two definitions. They are similar, and one is a little bit more correct. Is the quantity of money in circulation. The quantity of money in circulation is determined by banknotes and demand deposits. So, money supply is determined by banknotes. We call these banknotes in circulation, banknotes outside the central bank. These would be banknotes in your pocket. And demand deposits. Demand deposits, that's money supply. A separate function of the central bank, so let's try now do the following. Central bank functions. The first function I already defined. I only repeat. Monetary policy. This is the primary function. All others follow from this one. The second one is part of the definition, financial regulation. For most central banks around the world, the third main function is stable prices. This is usually called low inflation. Number 4. Stable currency. The currency should not change too much in value. And number 5 becomes stable financial system. Now, these are the so-called declared or official functions. This is what textbooks say, and now there is the truth, right? The truth is that the central bank has goals. They want to achieve specific goals. And the goals are very simple. Number one, the first primary goal, and therefore objective above everything else, is financing the government. The main job of the central bank is to finance the government. That's it. And number two is to support commercial banks. It supports them by many different ways. Number one, the best way to support the bank is to give it free money. Like, we call it in finance, but it's not correct. It's called cheap credit. Cheap credit. Just get a zero interest rate loan. In other words, commercial, you borrow from the bank at 10% or 7%, but the commercial bank borrows from the central bank at 1% or 0.5%. So it's cheap credit. That's number one. Number two is commercial banks are like little babies to the central bank. Central bank's job is to take care of its babies when they get in trouble, okay? And the one way to do that is called a bailout. Second main functional way mechanism that the central bank supports commercial banks is through bailouts. When the commercial bank gets in trouble, it gets a bailout. Bailout means the central bank gives it money and support it. It's like one big giant family, except that it works the other way around. The central bank is made by the commercial banks, it's of the commercial banks, and for the commercial banks. Central bank doesn't serve the people, doesn't care about people, doesn't care about stable currency, it doesn't care about stable prices. It will always sacrifice stable prices in order to finance the government or take care of them. In other words, central banks takes care of the government and the banks. If it has to sacrifice financial regulation, it will. If it has to sacrifice prices, it will. If it has to sacrifice the stability of the financial system, it will. It will do whatever it takes to take care of the government and to take care of commercial banks. That's the way the real world works, okay? Next, let's see what else we got. Discount, okay, discount credit. Now, the central bank will provide loans to commercial banks. So we call these discount loans. Discount loan is a loan given by the central bank to commercial banks. Usually to support the commercial bank for the purpose of helping out or bailing out the commercial bank. So that's a discount loan. The mechanism that it's done is said to be through the discount window. Discount window is a mechanism and a procedure for a commercial bank to borrow from a central bank. That's the discount window. And the interest rate which the commercial bank pays to the central bank is called the discount rate. Discount rate is an interest rate. The discount rate is almost always well below the market interest rate. In other words, it is cheap credit. And the difference between the market interest rate and the discount interest rate is like free money to the commercial bank. It's like the central bank giving a subsidy to the commercial bank. Therefore, the third main mechanism through the cheap credit is subsidies, various subsidies. Usually the main one will be interest rate subsidy. Interest rate subsidy. Subsidies are usually given by the government, but in this particular case is by the central bank. Next, reserves. What is a reserve? Reserve is an asset which an entity, we can also say financial institution, keeps to meet a liability. So if you got to make a payment for food, if you got to make a payment for rent, you got to make a payment for deposits, you got to make a payment for electricity, whatever obligation, we call it liability, you have to make, you will pay with an asset. It could be a cash, it could be some sort of a government bond, whatever you can make a payment with. So the reserve must be by definition very liquid. Very liquid. So the reserve is an asset, so it must be a liquid asset. And now, just in case somebody didn't understand or learn, the most liquid of all assets is cash. Okay. So the most liquid of all assets is cash. Okay. For a few thousand years, that would be gold. Okay, and today it is still gold. All right. Next one is from reserve becomes required reserves. Reserves. So required reserves are reserves kept by commercial banks to meet demand deposit obligations. So a reserve is just an asset you keep to meet an obligation. Any financial institution needs that. But a required reserve is a reserve required by the central bank from commercial banks to meet demand deposits. So required means by law, okay? And from there have minimum required reserves. Is the minimum percentage that commercial banks must maintain by law. The minimum percentage of required reserve. The minimum is usually as a percentage, 3%, 5%, 10%, which is percentage of the obligations, usually demand deposits. And then you have actual reserves. These are the reserves that the commercial bank actually has on hand, available. Now, next, if actual reserves exceed, are more than the minimum, you got more than what you need, the difference above the minimum is called excess reserves. Excess. Excess reserves are reserves above and beyond the minimum required reserves. And discount loans are usually for small amounts. Sometimes we call this, in general, the discount loan, we call this Fed credit. Fed credit, again, is a credit or loan to commercial banks. Usually a discount loan, and comes in 3 forms or 3 types, depending on the length of the credit. So the Fed will provide what's called an adjustment credit. It may provide a seasonal credit. And it may provide a extended credit. Extended credit. Extended is credit for long period of time because the commercial bank is in deep trouble and needs, it's for the purpose of helping out the bank to restructure, to make major changes in its operations because the bank is in serious trouble. So the purpose here is restructuring. It's credit given to a sick, near bankrupt or almost or insolvent bank in the hope of curing the bank. In the with the hope that the bank will actually heal itself. Seasonal is associated with some sort of a natural fluctuation in credit or deposits associated with the year. The two major seasons will be, number one, Christmas season, when everybody gets more money and everybody spends more money. So they kind of keep more cash in their pockets and they spend the cash. Traders, they don't keep the money in the bank. They usually keep it with themselves. They buy goods and all the other stuff. So everybody needs a little extra or a lot of extra money. And when Christmas is over and all the spending is done, if you're a trader, you pay back your, or dealer, meaning just someone in the market, you pay back your bank loan, you pay back your credit cards, you pay back your loans, you just had a profit, you deposit your money. So around Christmas, almost everywhere around the world, at least where Christmas is celebrated, you got a little extra demand for money. So the central bank will provide temporarily during the season. It's usually well known. It's usually been happening for hundreds of years. Will provide seasonal credit in the meantime. The second type of a season is like, well, it's a little tricky. We call it the cropping season. Is associated with agricultural crops. Sometimes farmers need to borrow extra money in order to buy seeds. Then they need extra money in order to buy fertilizer, in order to buy pesticides. So they need some extra money to do their crops. When the crop is ready and sold on the market and they get the cash, they'll pay back all of their loans and everything else. So you have seasons associated with celebrations like Christmas or whatever, New Year's Eve or whatever else you may have. In China, it will be Chinese New Year, very different from Christmas. And it's going to be associated with agricultural activity. Today, you may also have industrial activity. And adjustment, so this could last 3, 6, 9 months, 12 months. Seasonal could be 3 to 6 weeks. An adjustment will be maybe 3 to 6 days. Adjustment credit is given for a sudden surge of deposit outflows. Now, when something happened to the bank and yesterday or today the bank just needs $50 million. Maybe someone took a credit line. Maybe the bank had to make a payment. Maybe something happened or the investors panicked and went and pulled out money. When I was back in Bulgaria a year and a half ago, we had a bank panic. Suddenly everybody got scared that this particular bank will go bankrupt. And everybody rushed, the whole nation, everybody stopped working. There's no point in working if your money's in the bank, you're going to lose it all. You leave your job and go to the bank to get your money out. And the bank just keeps paying all day long. So when the day was done, the bank paid out about 900 million euro. That's about $1 billion US in payment. Well, they didn't have $1 billion in cash, so they took an adjustment credit from the central bank. The bank bailed them out. The bank helped them temporarily. Okay, and this, for me, completes what I had for chapter 4. Now, let's see any and all questions related to central banking or this particular chapter first, then to any other of the previous chapters before we finish with this topic and begin the next. Questions? No. Question?
Can you define discount rate again?
Discount